Hello again from Core Wealth. Can't believe it's already middle of February actually, and the year is flying by quite quickly. In the investment markets, there's something called the January effect, which essentially looks back in history and says usually in January markets are often stronger, and it's one of the stronger months in a year. That's not what we saw this January actually. This January we saw the local equity markets down, and that was predominantly on the back of what we've seen globally in emerging markets because of the outbreak of the coronavirus out of China. So we saw emerging markets around the world actually negative. On the back of that, we've seen the rand weaker during this month, and so it wasn't positive on the local equity markets. However, all of our portfolios are diversified globally, and the rand weakened during this month, during the month of January, and on the back of that, our international investments actually made up for the negativity that we saw on the local stock exchange. Let's just take a quick minute to look at the coronavirus. We've had viruses like this in the past. You had SARS back in the early 2000s. We've had swine flu. We've had avian flu or bird flu in between 2014 and 2017, and now the coronavirus outbreak. Now all of these things are not happy situations in the sense that people are dying because of it, but often these things get blown out of proportion with modern day media. The coronavirus, as we stand here now, there's been just over 1,000 confirmed deaths. But if we compare the mortality rate on the coronavirus to the other viruses I've just spoken about, it actually has one of the lowest mortality rates. In other words, of the people being infected, what percentage of them are ending up dying from the virus? The other interesting point at the moment is that the infection rate of the coronavirus is reducing dramatically, and so we could actually have seen the worst of it coming through if one has a look at the medical information that is coming out. So not a great situation to be in, but one where there has been a good response from China. Many of you have probably seen the articles about them building a hospital within a matter of days, a fully fledged operational hospital. Their response to the virus has been good, and we think that they'll get this under control quite quickly. In the meantime, emerging markets have weakened because of this news, thinking that trade between emerging markets and China in particular would be hampered, and we think this could actually have created, from a financial markets point of view, an opportunity to buy into emerging markets, which we think over the longer term, when we look at valuations, emerging market equities are the most attractively priced out of all equities globally. If we have a look at markets as a whole, 2019 was much better than 2018, but you can see our detailed commentary on that on the website. In short, we saw the local equity market up in 2019. We saw global equity markets up very strongly, and that benefited, and we saw all of our portfolios across the board being up quite nicely. They weren't up as much as we would have liked because we had some exposure to listed property, which hurt in the short term, as well as some exposure to more valuation-driven managers, which weighed on performance in the short term. We do expect to be rewarded for those holdings though in the longer term, as those underlying assets are very cheap, and through time, cheap assets are always rewarded if they're good companies. For the month of January, while the local equity market was down, we again saw the rand weakening, and that was positive for our portfolios. And in January, all of our portfolios were up for the month, some only just slightly, but our flexible fund, for example, the best performer in the month, was up 1.4%. If we have a look at what the portfolios look like in terms of expected returns, we are expectant over the next number of years. For the last 5 years, the Johannesburg Stock Exchange has only delivered a 5% return. Now that's only just ahead of inflation over that period of time. And that's been on the back of investors focusing less on emerging markets because you've had some exceptional returns coming from developed market equities. We do expect that to change, and we've seen global investors start to nibble on the edges around emerging markets. And more global investors identifying that over the next 5 to 10 years, emerging markets really look the most attractive. And as that turns, we would expect growth on emerging market equities, including South Africa, to actually improve. And we would expect to be rewarded for that in both our local and global portfolios, where we do hold global emerging market exposure. If we have a look at our bond market in South Africa, it remains very cheap, and that's something that in particularly the more conservative portfolios, investors are being rewarded with returns of about 4 or 5% ahead of inflation on a bond portfolio, which is very, very attractive. It's Thursday, the time of recording, and State of the Nation address is tonight. Later in the month, we've got the budget speech where Tito Mboweni will be talking about where things are heading. It will be a good illustration of how on side or aligned the ANC is behind the economic strategies that he is proposing for the country. Interestingly, there's been a few commentators of late who are suggesting that there is a chance now that we might avert a downgrade in March from a country point of view. Our base case is still that we expect it to happen, but it's an interesting point that some commentators think that this might be averted. We have seen a lot of support for a better working environment between Labour, business and government of late, which could be something that starts to push that in the right direction. Speaking about the budget, it is tax year end at the end of February. You will be contacted with regards to your retirement annuities, and also for those clients who have a rather large tax bill, there's also the Section 12J companies that you could consider investing in, which give you an attractive tax break. It's important that the underlying investments that are inside that 12J are actually credible, but we have some options that we can talk to you about. So if you're watching this and you do have a rather large tax bill looming at the end of Feb, please get hold of us, and it's something that we can put in place to minimize your tax over this period. If you have any questions around the markets or your portfolios at this point in time, please feel free to give us a shout. We look forward to chatting to you. Thanks for watching. We'll see you again soon.